Hello everyone, today we're going to talk about paying off debt using the debt snowball method. It's a simple change that you can make to paying off your own debt that will accelerate the time it takes to pay it off and also potentially save you thousands and thousands of dollars in interest. But before I get into that, please gently hit that like button and subscribe to the channel, as I'm going to be adding more videos on this topic in the near future. So what is the debt snowball? In its basic form, you pay the minimum on all of your debts. Then you take any extra money that you have and you pay towards your lowest balance debt first. Once the lowest balance debt is paid off, you take the amount of money you were paying towards that debt and you move it on to the next lowest balance debt. You continue to do this until all debts are paid off. This greatly accelerates the payoff for the loans and also saves you tons of interest. To demonstrate this concept, let's do an example. In this example, we have three debts. We have a credit card with a minimum payment of $72 a month, an interest rate of 23.99%, and a balance of $2,400. We have a car loan of $248 a month minimum payment, an interest rate of 6.99%, and a balance of $12,500. And also a personal loan that's $102 a month, an interest rate of 9.99%, and a balance of $2,200. For this example, we're going to use a calculated budget of $100 a month for additional debt paydown. With this example, paying just the minimums and not rolling any payments over, those three debts are going to cost us a total of $3,995.91 in interest over a period of 5 years. Instead of making the minimum payments, let's instead do a snowball strategy. So the first thing we're going to do is reorder our debt priority. And in this case, we're going to go lowest balance to highest balance, disregarding the interest rate. Why the lowest balance first? For quicker progress, so you see progress earlier. It's not the most efficient, but it's effortless and very effective. So what we're going to do is pay the minimum payments, with the exception of the personal loan. We will pay $202 for the personal loan. That's $102 minimum payment plus the $100 we previously discussed as budgeted for additional debt paydown. As time goes on, 1 year to be exact, the personal loan will be paid off and it will have a balance of $0. After it's paid off, we're going to roll over the $202 we were paying towards the personal loan into the next debt, which is the credit card. Our new payment for the credit card will be $274. That's the $72 minimum plus the $202 rolled over from the first debt. Fast forward 8 months and the credit card will also be fully paid off. After the credit card is paid off, we're going to roll over the $274 we were paying towards the credit card into the car loan. So our new payment for the car loan will be $522 a month. That's the $248 minimum for the car plus $274 rolled over from the credit card. Fast forward another 1.5 years later, and now the car loan will also be fully paid off. Now all debts are paid off. So using the debt snowball method, with the extra $100 a month, our total interest ended up being $2,536.92. That's a payoff time of only 3 years and 2 months. If we compare this to paying an extra $100 on the loans with no rolling of payments, basically paying the minimums and then paying the extra $100 toward debt, we would come up with a figure of $3,079.78 for interest and a payoff time of 4 years and 2 months. That's a year's savings and $542.86 in interest from paying the extra dollars on the debt versus paying the extra $100 using the debt snowball strategy. Now let's compare the debt snowball method with the extra $100 a month to just paying straight minimums to all of our debt. In the debt snowball example, the total interest is $2,536.92, taking a time of 3 years and 2 months to pay it off. Using just the minimums on the credit card, the total interest is $3,995.91, taking a total of 5 years to pay off. So using the debt snowball method is a savings of 1 year and 10 months and $1,458.99 in savings of interest. In our final comparison, we'll compare the debt snowball method without paying any extra payment towards the loans, just using the minimums and using the snowball strategy. And we'll compare that to just paying the minimums without rolling any payments over. So with the debt snowball method, the total interest ends up being $3,531.33 with a payoff time of 4 years and 1 month. If we just paid the minimums and don't roll those payments over, our total interest ends up being $3,995.91, taking a total time of 5 years to pay off. So just using the debt snowball method without any additional payment is a savings of 11 months and $464.58. So you can see how effective using the debt snowball strategy is in helping you pay off your debt. So now let's take that example one step further. Let's assume that the entire time you've had these 3 debts, you also had a mortgage of $190,000 remaining, 4.5% interest rate, and a minimum payment of $1,484.70. Once all the original 3 debts are paid off, we can then roll over the $522 we were paying towards the car loan into the mortgage. Our new mortgage payment will be $1,484.70. That's the $962.70 principal and interest payment plus the $522 rolled over from the 3rd debt. If we do this, it knocks the 30-year mortgage down to a 14-year, 7-month mortgage and saves us $87,265.40. A dramatic savings just by rolling in money that we were already paying towards our existing debts into a new debt. I hope this explanation of the debt snowball strategy has been very informative. As I stated earlier, I will be releasing other videos on paying off debt and showing more optimal ways of paying it off quicker. If you still need help planning your own debt situation, I offer a consulting service that can help you plan step by step on how to pay off your debts. Just visit the website linked in the description of this video. Thank you and have a good day.